Well, we do see fractional losses, really just a pause in what's been an incredibly strong rally. The S&P ended last week just 3% from its February record after dropping 20% in April from that recent high. Of course, a lot to digest this morning as the S&P does open down by about 0.6%. And joining me now with more is Lawrence Gillum, Chief Fixed Income Strategist at LPL Financial. Lawrence, thank you so much for joining us this morning from Charlotte. And as we open here, we do know that bond prices certainly are having an impact. What can you tell us?
Well, yeah, I mean, it's been almost one-way route higher for Treasury yields here over the past couple trading sessions. We've breached 5% on the 30-year and breached 5.5% on the 10-year, both psychologically important levels. From a technical perspective, I'm not a technician, but I think from a technical perspective, the path of least resistance is still higher for these Treasury yields.
Interesting. And what is fueling that march higher for the yields?
Yeah, you can pick a number of different catalysts, really. Certainly the recent narrative about the Moody's downgrade is probably playing some into this, but we think it's a Fed on hold, inflation expectations that continue to rise. Sticky inflation, like we saw today out of the UK, then you have what we think is the primary driver of these higher Treasury yields, and that's just the ongoing debt and deficit spending that's coming out of Congress. The big beautiful bill is turning into something that the bond market, frankly, isn't particularly excited about right now.
Mm-hmm. How is this bill that is working its way through Congress, our guest earlier anticipates potentially signed by the president after Labor Day, expected to impact the market? And what is the deadline that you anticipate and as to when this agenda bill, President Trump's agenda, what he's called the big beautiful bill, might actually pass?
Yeah, so we've been looking at Memorial Day weekend as the date that the discussions will really come to a more earnest level. It sounds like that's going to get pushed back sometime during the summer months, perhaps August, September. Keep in mind, though, that I think what's important to remember is that along with this big, beautiful bill, they're also in discussions about raising the debt ceiling. The Treasury Department has noted that they will run out of money around the August timeframe. So if this is not settled by August, we could get some additional volatility out of the rates market. But as it relates to how the bond market is really thinking about this bill, there's a couple things to mention. The deficits are set to expand as the bill is currently written. There's estimates that the deficit could expand by 300 to 400 billion a year. That means more Treasury issuance that the market has to digest at a time where there's potential foreign buyers walking away from our market. Central banks, as we know, have started to reduce their purchases of Treasuries. So it's one of these supply-demand dynamics that is another reason why we're seeing these higher yields on the U.S. Treasury curve right now.
Lawrence, with these higher yields, how do you anticipate that will impact other markets like the mortgage market and the equity market?
Yeah, as it relates to the mortgage market, as we know, the mortgage rates tend to get priced off the 10-year Treasury yield. There's a spread in between 10-year Treasury yields and mortgage rates. So as the 10-year Treasury yield moves higher, that means mortgage rates are likely going to head higher as well. We breached 7% recently on the 30-year fixed mortgage rate again. We saw that last year as well, but now it seems like we're going to stay at these higher levels for mortgage rates, which is not a good sign if you're a new homeowner or a new home buyer that's looking for a house to buy. As it relates to the equity markets, yeah, I mean, we've been looking at the move higher in yields and expecting some sort of reaction out of risk assets, and we just haven't gotten it yet. So far, anyway, equity markets, credit markets have been able to digest these higher rates, but eventually there will be a level, whether it's call it 475 on the 10-year or 525 on the 30-year, where that is going to cause some indigestion for a lot of these other risk markets that, frankly, haven't really priced in a lot of bad news at all.
How does that inform the Fed's path forward, Lawrence? What they might see playing out in the bond market, of course, impacted by the so-called big beautiful bill, as well as changes to trade policy.
Yeah, so it's a very important question, right? So, as we've learned over the past couple months, the Fed has decided that they're going to stay on hold for the foreseeable future. They point out just a lack of clarity, and they're absolutely right to call that out. There is no real clarity in markets right now, and as these bills go through Congress and potentially add to these inflationary dynamics, we could argue that this big beautiful bill could be stimulative to the economy, which if that's the case, that probably keeps the Fed on hold for longer. So it's one of these things where the Fed is in a really tricky situation right now. I think we think if the economy were to slow, particularly within the labor market, you could get a couple rate cuts out of the Fed. But until we see that hard data really soften, the Fed is probably on hold for the foreseeable future.
Lawrence Gillum, Chief Fixed Income Strategist at LPL Financial. Lawrence, great to see you this morning, and thanks for joining us from Charlotte.
Thanks for having me.